So, good afternoon, everybody. My name is Joel Joshua. My topic chosen for this presentation is financial statement analysis. We have seen session 1 where we discussed about essential elements of financial statements, income statement, balance sheet, cash flow statement, and we also learned how they are linked. We have also known about certain items such as other comprehensive income.
One, two, three, four.
And in this session, we will be focusing on part 3. Right, sorry. So in this session, we will be learning about the financial statement fraud analysis. As we have all covered the essential basics in the previous session, now I'll be covering on how a fraud occurs in statements. I'll be answering questions like what are the red flags that we should be aware of, and if you are analyzing a company, how you can identify these red flags. And also, I will be discussing a few case studies where we have seen fraud happening in those companies, and also a few models which we will be using. Now, before I get started, I want to let you know that the methods and case studies which I'm going to share, we just cannot directly say that, okay, this happened, then the company must have done the scam or fraud. No, we just cannot say that. We are not accusing anybody. I would like to mention the quote famous in auditing, like an auditor is a watchdog, not a blood wound. We will be doing similar to what this quote says. It means we will be observing the financial statements, we will be questioning them, we will dig deeper, we will see beneath the surface of what's being presented to us. When we see something is wrong, then we will gather more information about it and see what's going wrong exactly. We will do an investigation. So that's my intention. Now, that being done, let's get started. First, we will know by knowing the red flags in balance sheet. The first one is when the cash flow from operations are not in line with the net income that the company is reporting. So if the company is reporting net income, then it should realize we should see it in cash flow operations. If we are not seeing it, then a question rises, what's happening? Why is the net income that is reported by the company is not showing up in cash flow from operations? So this will be the first red flag. The second one will be frequent hiring and firing of auditor or CFO. So we all know what an auditor or CFO does. They know the statements of the company. So if an auditor or CFO is being hired or they're leaving the company again and again, then we should think there's something wrong or possible that something is not well in the company. Because one time could be it could be okay. It could be due to the personal reasons or something. But again and again, repeating of the same event, it should raise a bell in our heads. The next red flag would be too high interest cost on loans or too low interest on loans given. So if we see a company, they have a loan, and in the industry, you see that in that specific industry, the loan is at so, for example, let's say some 15%, but the company you are analyzing now, they're only reporting it as less than what it's supposed to be, or maybe more than what is the industry, than what is common in the industry. Then if you spot either of those scenarios, then you should be careful. You should evaluate why it is not being same as rest of the industry. That is another red flag. And next, next is very high related party transaction. So related party transaction is when promoters are benefiting in the cost of the company. So I would like to explain this using an example. In March, in recently we have seen a case, Gensol Engineering, where we have seen that this company has siphoned off its funds to another parent company called Blue Dart. So the promoters are same for both of the company. They just misplace the funds from one company to other company. So this could be an example of related party transaction. And we will also see another related party transaction in the case Satyam scandal. That's another example of it. Another red flag could be ineffective corporate governance. And corporate governance, as we all know, it includes a board of directors, independent directors, board structure, composition. Now, these corporate governance, the members who are in the corporate governance are the ones who take the decisions as they're the top level management. And it is also with them, if there is any manipulation, and it all begins from them. So we should see the reporting of the company to know about the corporate governance. It becomes essential to check it. Next is a large increase in accounts receivables. So when you see an very abnormal spike or a sudden increase in accounts receivables, then it could be possible that they have used it to inflate sales, or it could be something else. But when you see any abnormal spike, you should know the reason behind it. We also do the same for ratio analysis. We use it to see abnormal spikes or trends. It's the same case here as well. Frequent changes in accounting policies. Now a company can use different policies to report their financial parameters. Now, if a company is changing frequently, then it is generally not considered as a good sign, because it could be covering of something, or underreporting or misreporting, or portraying of better than the actual state or less than the actual state. So unless we know the reason clearly why there is lots of changes in accounting policies, we should be aware of it. Same case, same as frequent change in accounting policies, same as that. Restructuring is when you reconstruct all of the company again, its loans and its financial health. Now, if your company is involved in frequent restructuring, then you should be careful of it. Major changes in common size ratios. I have said this before. If we see any huge spikes when we are doing any analysis of a company, then you should dig deeper and find out why it is like that. Line items not matching industry standards. For a specific industry, the expenses are unique. For example, in electronics company, we have expenses specific and unique to only to the electronics industry. In oil industry, we have expenses of their own kind of expenses. Similarly, if we see an expense that is generally not common in that within that industry, then you should look into it. Now, if there are too many subsidiaries, if a company has too many subsidiaries, then we should break it down and get a clear understanding of the performing and non-performing subsidiaries. However, it just doesn't mean that it has involved in any fraudulent activities, but if there are too many subsidiaries, then we should have a check. We should have a look. Now, those are the red flags of the general red flags in balance sheets and fraudulent activities we see in the companies. But we'll be moving on to real world case studies. Now, before I move on to a case study, I want to explain to you about a concept so that it will help you understand the case study in a better way. It's a free cash flow. So if you want me to tell me the textbook definition of free cash flow, then it is simply how much the company finally has after deducting all of its expenses, capital investments, all of their expenses. Finally, what the company has. Now, I have also a really fun way to explain this definition. You can say an analogy more like, but it's a fun way to explain it. You can say net income is the boss we think we have defeated in the video games we play. But until free cash flow appears like the final twist in the video game. You think net income, we are done with the net income because is the figure we get after deduction of all expenses. But no, apart from net income, we also have another metric that is free cash flow. It is the real measure of power. It decides whether the company can fight another day or pay dividends, or it can invest somewhere else or even survive. We have a formula to calculate free cash flow. Cash flow from operations minus capital expenditure. Now, how to find capital expenditure? We should take ending net property, ending PPE, minus beginning PPE, then add depreciation. Now we are off to our first case study, WorldCom. So WorldCom is an American company and its growth largely came from making acquisitions. It has expanded its business by acquiring other companies. And they have always been the same. They have always used aggressive accounting practices to inflate their earnings and operating cash flows. But when they tried to acquire another company in October 1999, the US Department of Justice disapproved a merger, citing monopoly concerns. And now WorldCom was left without infusion of new reserves that it needed. And by early 2000, there was immense pressure from the Wall Street for the earnings, to hit earnings. One of the WorldCom's major operating expenses was line cost. So WorldCom is a telecom company. So these line costs are the expenses which include in the expenses in the telecommunication network. But the WorldCom has done something different. They have added this line cost, they have capitalized, meaning they have shown it in the asset side. Or to be more specifically, I think you should be able to guess by right now. We should be able to guess because they have moved it to the asset column. They have what was expense, line cost, they are showing it as expense now, inflating their statements. Now, an analyst or aspiring analyst like you and me, if we have carefully studied the cash flow statement of the WorldCom, we could have figured out what went wrong. Now, what is that metric? That metric is free cash flow itself, because when we capitalize it an asset, it will show up in the capital and expenditure. It comes under capital and expenditure because they have capitalized the line costs in there. Therefore, they are showing as they have inflated and manipulated the statement. If we studied the cash flow statement and calculated the free cash flow from that, then we could have understood that something was wrong. Generally, most of the scams, they say we can see it from the cash flow statement. They say it is very difficult to manipulate cash flow statement. So that was WorldCom, where they used the line costs and showed it as capital expenses. And how we can find it? Free cash flow. Free cash flow is the answer. Now we are off to another scandal within India, Satyam scandal. So at first, Satyam Computers appeared to be one of the India's brightest success stories. It was even listed in NASDAQ. It was lauded as India's Enron, of course, after the scandal. And in January 2009, the CEO of the company, Ramalinga Raju, has confessed to orchestrating a financial fraud that lasted over 10,000 crore in fictitious asset balances. So this crown jewel, so-called crown jewel, was never profitable, as it claimed. It had never had the cash reserves reported. It was having weak corporate governance, complicit auditors, and regulatory blind spots. So we'll know what really happened here. So how this scam was brought into light? It was by Mehta's Infra. What revealed was that the Satyam was siphoning off funds from Mehta's Infra, another of their own company. If you can see Mehta's, if you can start, it is a palindrome, right? If you start from Satya, it is just Mehta's is just Satyam reversed. So they were siphoning off funds to this Mehta's Infra, and The CEO had plans to acquire this real estate venture, and Mehta's Infra was run by their own sons of the CEO. But the shareholders of the company had rejected the acquisition of Mehta's Infra because CEO was about to use shareholder funds in acquiring this company. And soon after, the CEO of the company has confessed that he had been riding a tiger, not knowing how to get off without being eaten. Let's uncover, let's look at the financial statements and see what really went wrong, how it happened. So I found this in CC site, US SEC. Even you can have a look. We can see that there are lots of cash. We have cash over here and lots of bank deposits. Now, first of all, what is a software company doing with huge cash balances in bank? It doesn't make sense. And again, if you see the interest income, only it is less. If you see the cash balances, we had that much cash balances, but the interest income, don't you think it is far too less for the deposits they have made? And this is the first red flag I have talked about. First, I have talked about comparing net income and cash flow from operating activities. Generally, if we should keep it in graph, generally those two lines hug each other. They are in a similar wavelength, but if they have lots of variance or they are not like that, then you should be aware of it. Then you should be suspicious of that, why it is like that. So after Satyam CEO confession, PwC, who was the auditor of Satyam, was banned from auditing financial statements for 2 years. This is the original statement, as you can see over here, original, and there are, you can see the cash and bank balance, 5,040 crores. So huge manipulation, fictitious cash balance. The cash just, it did not exist. That's why the interest income was also too low. That was Satyam scandal. How you can know it? You should be able to say Meta's infra, failed acquisition, and fictitious cash balances, all of that. Next case studies, we are off to Kingfisher Airlines. Kingfisher Airlines was a premium business model where it just does not work in Indian context though, but they have made it like that premium business model. It was a symbol of luxury and style in Indian aviation. And right after 2008, the Kingfisher Airlines have started facing problems. They used to have high operating costs. Of course, because if you want to provide some previous luxury, a premium luxury towards the passengers, then you will be having high costs that you must undertake. And what was already failing business, struggling business, they have acquired Air Deccan in 2007. It just added even more financial burden. Yes, sir. After acquiring Air Deccan, they got access to more routes, but what debt they Air Deccan had, it was all imposed on Kingfisher's Airlines shoulders. And by 2011, the Kingfisher Airlines was in deep trouble. It was unable to pay loans. It was unable to pay its employees and suppliers. and it's all downhill from there. October 2012, the DGCA has suspended its license. We can see from the graphs over here. The red in the line graph over here, the color marked by red is interest coverage. We can see that it's almost at 1 year it was for zero, above zero, and remaining years it was a negative. Debt to equity was just shot up in the sky. And at the second graph, cash flow from operations and net income. So we can say that Kingfisher Airlines just never saw profit, barely any profit. It's almost near zero. And after 2012, after suspension of license, it was all time downhill from there. Same, Air Deccan had made it worse for Kingfisher to already what was failing business, or to already what was weakened financial state of the company. Now here, Enron. We are off to Enron now. So let's talk about what kind of company Enron is before. Enron was a large energy, commodities, and services company based in Houston, Texas. And what was surprising was at Enron's peak, what shares were $90.75 each share. When it declared bankruptcy on December 2nd on 2001, each share just only became 26 cents. Just nothing. From $90 a share to 26 cents. What happened? What happened at Enron? What led to this? We'll know that. So this is the timeline of Enron. We can see CEO Jeff Skilling resigns. This scandal was brought out in 2000, after 2000, 2001. From 2001, we had all the drama around quote. So first, CEO Jeff Skilling resigns. After that, whistleblower Sharon Watkins meets with new CEO Ken Lay, and CEO Ken Lay encourages employees to buy stock. Enron acknowledges SEC investigation. SEC had made formal investigation in 2001. Enron says it's overstated in earnings by 600 million. So it's confessed. And Enron files for bankruptcy. And at the end, largest corporate bankruptcy at this time, 2001. It was the largest bankruptcy then. Before Enron, I guess it is WorldCom. WorldCom is largest bankruptcy before Enron. And after Enron, I'm sure it is the Lehman Brothers, if I'm not wrong. In 2008, that is. So how they did this scandal? What happened to Enron? Inflated profit. So Enron has used an accounting system, or we can say a way of recording the accounting entries called mark-to-market accounting. What it helped them was they were able to record revenue before it was even realized. Hence, the profit and figures they have mentioned in their financial statements were not true. They were not communicating the real state of the business. And they have also created something called as special purpose entities, where using them they have hidden debt, and round tripping transaction is just dummy deals and selling and buying energy contracts. It's like that is a round tripping transaction. And why they did this scandal to keep stock prices high? Of course, if stock prices are high, then CEO and top level management benefits from that. To sustain investor confidence, pressure from leadership. This is taken from Enron's statements. If you compare cash flow from operating activities and net income, we can see the wide gap at year 2000. If there is such wide gap, you should be aware of it. Net income is almost flat since 1998 to 2000, but we have lots of variations in cash flow from operating activities. How the fraud was revealed, we have read earlier. Sharon Watkins. He was the whistleblower. Aftermath, Arthur Anderson. Arthur Anderson is the auditor of Enron's statements. He was just given money. He was not really auditing. Just signed off. Took money from the company and signed off the statements. After the Enron was revealed, it led to the formation of the Sarbanes-Oxley Act. We popularly call it as SOX Act, where through this act they have led to strengthening of internal control frameworks, auditor independence, and also public company accounting oversight board. There is a model, there is a statistical model where you can use it to see if a company is manipulating their statements or not. I have done this model on Enron, but before I show it to you, let's understand what this model says. In this model, we have 8 ratios. You can see in the image there. Each 8 ratios talks about a certain item. Day sales, receivables matrix, it talks about revenue recognition, whether receivables are growing faster than sales. And we have formulas for each of the ratios where we should calculate. And if you see T under the receivables, it is the current year of whatever the year you are calculating. For example, Enron's was the year 2000. If you are calculating NISM score for the year 2000 of Enron's statements, then year 2000 will be T, and T minus 1 will be the previous year. Year 1999 will be T minus 1, previous year. This is an example. T is the current year, T minus 1 is the previous year. Now other ratio, we have a growth margin index where it sees the profitability, because companies have pressure to report higher higher profits. If a company tries to present their statements in such light, then we can catch it under this ratio. Sales growth index is simple, just sales growth. Sales of current year and compared to initial year. That's it. Asset quality index is that when companies try to manipulate this statement using assets, such as Satyam will fall under this, because they have manipulated their current assets, or more specifically cash balances. Sales general administrative expenses, where if the company is trying to understate expenses, and leverage, we will be able to see to a total debt. So what companies do is that they underreport debt than what's the actual debt in the company. So if that is indeed the case, then you will use this ratio. The final 2 ratios are depreciation. So depreciation a company might underreport a depreciation because you need to deduct depreciation in the income statement for the profit, right? So what some companies might do is that they might not deduct depreciation, hence boosting their profit by some margin. Total accruals to total assets is you take income from operations, that is just operating income, minus cash flow from operations by total assets. And this is the final score. After calculating each of the ratios, you should keep under this formula where minus 4.84, 0.92 into, for example, DSRI. I calculated DSRI and it is around, let's say, for example, 0.94. Then I will include that value 0.92 into 0.94 or X or something, whatever the value you get after your calculation. Now, how to interpret the result? When you keep the values in those variables, you will get the final answer. If the final answer what you got was less than minus 1.78, then they're likely not manipulating earnings. If it is greater than negative 1.78, then likely earnings manipulator. Now, as I have said, I have applied this model to Enron's financial statements. Let's have a look over that. Yes, these are the statements. This is actually available on the internet. You can just type Enron financial statements and you will get all from 1997 to 2000. You will get the statements of all the years. You can try this by yourselves too. Here I have included all the ratios. I have calculated for each year for 1998, for 1999, for 2000. And for 2000, we can see it is 0.02. Earlier, I have said that if the value you got is less than negative 1.78, then it is probable that the company, whatever the company are analyzing, is inflating their financial statements. So yes, that's the real application of this model, of this statistical model. But there are some limitations which I would like to let you know. But again, we have the problem of data accuracy. Like it may or may not be, like we cannot be sure of the data that we are having. And if the statements you have taken, if they have any negative values, let's say selling and general and administrative costs were negative, generally that will never be the case. They cannot be negative. For example, if you take faulty values, then the total interpretation of the model will change. You might even say the company which is integrity, which is with integrity, you can say the model might say it is manipulating its earnings. So before you use this model, we have to be extremely careful of how we are, of what values we are giving the model, of what input we are giving, and checking twice if they are correct or not. That's the main limitation of this model. And also, this model was created using American financial statements. So I did not apply this to our Indian financial statements. So it is possible that it might not entirely catch exactly contextual limitations. Like each country will have different context. So as you change the geography or that context, it might be different. The result might be different. So we have to be careful of that. And also the key takeaway which I did not say earlier was if you are calculating Danish M score, you have to take each of that value. You just cannot say one depreciation index and be sure that this company is manipulating their earnings. No, it is not like that. You should compare each of the ratio to all of that formula. It is in combination of other ratios. Then only you should take the conclusions. You should never base your conclusion on a single ratio. That's very important. And also, though we have these limitations in our Benisham score, if we combine with these other items such as forensic cash flow analysis, Benford's law, auditors red flags, the whistleblower tips, we need to combine. We will take the values from our model and we will also compare it with the external environment of the company, which will help us our conclusion being more accurate. It will increase our chances of being more accurate. So that's about the forensic accounting. And now we are off to credit analysis and liquidity. Credit analysis is just you are thinking, if you are a credit analyst, you will be thinking whether I should be extending credit to this company or not. Now, how it is done? We have ratios for that: liquidity ratios, current ratio, quick ratio, absolute cash ratio. More ways of this, but I could not add more of it. I'm only covering few of the ratios. Section 1, liquidity. Liquidity, as we all know, it is the ability to convert assets into cash or to obtain or to meet the short-term obligations. Now, if a firm has low liquidity or it is not doing well, it is possible that it could go bankrupt. And also working capital, we also use working capital to see if the firm is competent enough to extend credit. Now we define working capital as excess of current assets over current liabilities. We have seen from the previous session that about current ratio. Now this is just the same thing, but even more extension of it. So we'll see relevance of current ratio. Why we use current ratio to assess liquidity? First, current liability coverage. The higher the amount of current assets to current liabilities, the greater assurance we have that the current liabilities will be paid. Current ratio will also tell us about the buffer against losses. It is also the reserve of liquid funds. Now coming to the main limitations of the current ratio, where we have the major limitation of current ratio, where it cannot give us an idea about future cash inflows of the company that we are analyzing. Future cash inflows are the greatest indicator of liquidity. Now there are certain risks of working capital. Overtrading implies that if you're seeing the working capital of a company, you will be checking its current ratio. Generally in India, we see if the ratio is 1.33, then it is adequate. For outside India, it is generally 2, but we see it is If it is 1.33, then it is okay. Now, to analyze this, we have some working capital risks. What we see before extending credit. So what trading implies when the business is doing beyond their capacity. That is over trading. Diversion risk is when you have given a loan, working capital loan to some company, and instead of focusing on their core business, they're in using it for another purpose. Then it is called diversion risk. Inadequate financial management is when that company you gave loan or extended credit to is not able to manage their finances properly, or they're not able to, for example, recollect their receivables. Then it comes under inadequate financial management. Inflation risk is the external risk, we all know. Inadequate provision. Without the necessary working capital, the entire investment is may come to naught. Like there should be a proper provisioning of working capital in projects. Now we will be seeing operating cycle. This cycle is linked towards working capital. Capital cycle, it measures the time it takes for a business to convert its net working capital into revenue. We can see over the image over here. From purchase, seeing raw materials, to production process, work in progress, finished goods. We can divide this cycle into two parts. From raw materials, work in progress, we can say it is raw materials production, and from finished goods, from where it became cash, you can say it is receivables collection. Two parts. If you combine these two, it includes operating cycle. Now we also have another cycle. It is called cash conversion cycle. It measures the time it takes a company to convert its investments into cash. Now, operating cycle is product centric, and cash centric is only focused on cash. How much cash the business is having with it. We have a formula for a cash conversion cycle where it is days inventory outstanding, days sales outstanding, and deducting days payable outstanding. And one point which I missed was, if we see FMCG companies, they will have very short operating cycles. They will be able to convert their what they bought into cash much quicker. It depends upon the industry. Operating cycles depend upon the industry. Now, if it were the industry of, let's say, shipbuilding, then the operating cycle will be much more longer. Let's delve into the formula. Day sales. Okay, first, days inventory outstanding. It shows the average number of days it takes a company to sell its inventory. And days sold outstanding, it helps us determine how many days it takes to collect cash from customers after a sale. Days payable outstanding, number of days it takes a company to pay its suppliers. Now, if you are the great analyst, you will be checking all of these formulas of that company. Then after through this, you will come to a conclusion whether to give it or not, to give loan to this company or not. Now, capital structure is also a very huge important parameter in liquidity. Where capital structure, we need to have an essential mix of both equity and debt financing of a company. Only through that efficient allocation of the mixture of equity and debt, we can have liquidity. As we all know that concept, we need to pay the creators of the company first. So it is mandatory to pay creators after each month. So it becomes an important parameter in checking the capital structure of the company. Here it is mentioned over here. Unlike equity capital, both short-term and long-term debt capital must be repaid. So you must keep that in mind to assess a liquidity of a company. Now we are off to the last model of my session. It is Altman Z-score. Through this model, we see the possibility of a company going bankrupt. It is a statistical model. It was developed by Edward Altman in 1968 as the financial stability of companies. Same as M-score, but the values are different and the concept and the ratios are also very different. But same model, similar. They both are statistical models where X1 is working capital by total assets, retained earnings by total assets, profit before interest and tax, total assets, market value of equity, book value of total debt, sales by total assets. We all take these values and compute them. After computing them, we'll apply to this formula. And after that, the final value get will interpret if the company is in distress zone, if the company is in gray zone, or if the company is in safe zone. If the company is in gray zone, then it is uncertain. It is uncertain about the company. It could go either way. It could be safe zone or it could be distress zone. If you should be more particular or if you should more accurate about that, then we should dig deeper. Now, according to Altman, the Z-score can predict with over 95% accuracy. There is He has seen this model with the 33 bankrupt firms and it was 95% accurate. Now there were also several limitations of Altman's Z-score. Mainly the same limitation again that the context of the business is different because it was done on American companies. So some sort of contextual differences might arise when you are analyzing. So that comes to an end of my session. I thank you all for hearing my session. And I also thank iCapital for giving me this opportunity. Thank you.